Hey everyone, we're diving deep into some pretty fascinating economic action today. It's all about the RBI and, that massive USD-INR swap auction they just pulled off. It's making headlines, and trust me, this is exactly the kind of real-world economics that UPSC examiners love to throw at you.
Absolutely. We've got some great insights from the Hindu in business today to help break this down. Ready to unpack it all?
Totally. Now, I know UP&R buy-sell swap auction might sound like something straight out of Wall Street,
Definitely a mouthful.
but bear with me, it's actually not as complicated as it seems. It's like, imagine you need some rupees, right? Like a good chunk of them for a few years.
Okay, I'm following.
And let's say your friend's got some extra dollars just sitting around. So you strike a deal. You swap currencies for a set time. They get the rupees they need right now, and you get to hold on to their dollars.
Simple enough.
Then when the time's up, you swap back. Maybe you toss in a little extra for the favor, like a thank you. And that, in a nutshell, is pretty much what the RBI is doing with banks right now.
Ah, so it's like a temporary exchange of currencies.
Exactly. But here's where it gets really interesting.
Shoot.
The RBI is actually using this swap to tackle a bunch of economic goals all at once.
Multitasking at its finest.
Think of it like this. They're trying to keep the banking system flowing smoothly, right? So they inject liquidity into the system. It's basically like giving banks more cash to lend out. But at the same time, they're also trying to keep the rupee from weakening too much against the dollar.
A delicate balancing act.
It is. And you know what? Getting those two things right, that could be a game changer for controlling inflation. And we all know how important that is for the Indian economy, not to mention a pretty common topic in the UPSC exam.
Oh yeah, definitely high yield stuff for those exams. But I gotta ask, how can the RBI be sure that this won't kind of backfire? Won't pumping all that liquidity into the system just lead to even higher inflation later on?
That's a great question. And yeah, there's definitely a risk. Too much liquidity can absolutely fuel inflation. But here's the thing. The RBI has other tricks up its sleeve.
Oh, I'm sure they do.
Like they can adjust interest rates or use what's called open market operations to sort of fine-tune things. It's all about finding that balance, that sweet spot for economic stability.
A constant juggling act.
Totally. Now, let's talk numbers for a sec. This auction, it wasn't messing around. It was huge. $10 billion. That's what they put up for swapping. And for a period of 3 years, not just a quick in and out. So what does this all mean for the USD-INR exchange rate? What are we expecting to see?
Well, 10 billion, that's a serious statement. It shows how committed the RBI is to keeping the rupee stable. Market analysts are predicting that we might see the USD-INR spot rate move towards 86.30.
Okay, so a potential strengthening of the rupee.
Right. But what's even more important is the impact on investor confidence. Seeing the RBI taking these proactive steps, that can make India a much more attractive place for investors. It's a signal that the economy is in good hands.
You know what? I hadn't thought about it that way, but that makes a lot of sense. All right, so let's get into the nitty-gritty of this swap. I mentioned it's a two-legged process. Sounds a bit like, I don't know, a complicated dance move.
Uh-huh. I guess it could sound that way. But it's not too difficult to grasp once you break it down. So picture this. First leg of the swap, banks hand over their dollars to the RBI, and in return, they get rupees. It's like a quick switcheroo, like changing partners in a dance.
Okay, I'm visualizing it.
And this exchange, it happens at what's called the FBIL reference rate, which is basically the standard price list for currencies set by, well, it's a bit of a mouthful, but it's set by Financial Benchmarks India Private Limited. Then, fast forward 3 years, second leg of the swap, the banks give those rupees back to the RBI and they get their dollars back. Plus, a little extra the RBI throws in on top of those rupees called a swap premium. Like a thank you gift for the dance, so to speak.
Ah, so it all comes full circle. I'm starting to see the big picture here. RBI wants to stimulate the economy, keep the rupee strong, and the swap auction, that's one of their tools for getting it done. But for us UPSC folks, the real question is, how does all of this translate into potential exam questions?
That's the key, right? Because this whole scenario is practically a textbook example of what you might see on your exam. Imagine a question popping up about how the RBI manages the rupee or tries to keep inflation in check. Boom, you've got the swap auction as your real-world example.
Perfect case study.
You can talk about the mechanics, the impact on liquidity and exchange rates, even how it ties into bigger economic goals, like promoting growth while keeping inflation under control. It's all connected.
This is gold. I hadn't even considered the investor confidence angle before, but you're right, that's a crucial point.
It's a big deal. And remember, this specific option is just one piece of the puzzle. It connects to a whole network of concepts that are super relevant to the UPSC syllabus. Forex reserves, open market operations, how the RBI controls the money supply. It's all part of the same economic ecosystem.
Mind blown. So much to learn, and this deep dive has definitely given us all some serious food for thought. And a huge shout out to the Hindu of Business Today for the fantastic insights. Be sure to check out their articles for a more in-depth look at this swap option. Don't forget to hit that like button, subscribe to keep those UPSC insights coming, and drop a comment if you've got any questions or want to chat more about this. Until next time, happy prepping.